Alfonso Cahero, A Journey into Finance History. Chapter 70, Expansion of Digital Banking and Fintech, 2010s-2020s, Technology-Driven Financial Services, Reshape Banking and Investment. In the early 2010s, the financial world was at a crossroads. Traditional banking institutions were facing growing pressure from various fronts: economic instability, changing consumer preferences, and technological advancements. This era marked the dawn of digital disruption in the banking sector. Amidst this landscape, a wave of innovation emerged, fueled by the convergence of finance and technology. This fusion, commonly referred to as Fintech, brought forth a new breed of financial services that leveraged cutting-edge technology to streamline processes, enhance customer experience, and democratize access to financial services. Startups and tech giants alike began to challenge the status quo, introducing innovative solutions ranging from mobile banking apps to peer-to-peer lending platforms. The stage was set for a revolution that would transform the financial industry forever. As smartphones became ubiquitous in the early 2010s, consumers increasingly sought convenience and accessibility in their financial dealings. This demand gave rise to mobile banking, an innovation that allowed users to manage their finances on the go without the constraints of traditional brick-and-mortar branches. Mobile banking apps offered a plethora of features, from basic account management to advanced functionalities like mobile check deposits and person-to-person payments. These apps empowered users with unprecedented control over their finances, fostering a new era of financial independence. Banks and fintech startups competed fiercely to deliver the most intuitive and feature-rich mobile banking experiences, leading to a rapid evolution in the landscape of digital finance. As mobile banking gained traction, traditional banks were forced to adapt or risk becoming obsolete in the digital age. In 2008, an enigmatic figure known as Satoshi Nakamoto introduced the world to Bitcoin, a peer-to-peer digital currency built on a revolutionary technology called blockchain. While Bitcoin initially sparked skepticism and intrigue, it laid the groundwork for a profound transformation in the realm of finance. Blockchain technology, characterized by its decentralized and immutable nature, promised to revolutionize traditional banking processes such as payments, settlements, and identity verification. Its potential to eliminate intermediaries, reduce costs, and enhance security captured the imagination of entrepreneurs and innovators worldwide. As the 2010s progressed, blockchain went mainstream, with industries ranging from banking to supply chain management exploring its myriad applications. The emergence of cryptocurrencies and smart contracts further fueled the blockchain revolution, challenging conventional notions of trust and governance in the financial sector. In the aftermath of the 2008 financial crisis, traditional lending institutions tightened their lending criteria, leaving many individuals and small businesses struggling to access credit. This void in the market paved the way for the rise of peer-to-peer, P2P lending platforms, a disruptive innovation that connected borrowers directly with individual investors. P2P lending platforms leverage technology to streamline the lending process, offering borrowers lower interest rates and investors higher returns compared to traditional financial intermediaries. By cutting out the middleman, these platforms democratized access to credit, empowering borrowers with alternative sources of financing. As P2P lending gained traction, regulatory scrutiny intensified, with authorities grappling to strike a balance between promoting innovation and protecting consumers. Despite regulatory challenges, P2P lending continued to flourish, transforming the lending landscape and challenging the dominance of traditional banking institutions. In the realm of investment management, the rise of robo-advisors heralded a new era of democratization and accessibility. Robo-advisors, powered by algorithms and artificial intelligence, offered automated, low-cost investment solutions tailored to individual risk preferences and financial goals. By eliminating the need for human financial advisors, robo-advisors drastically reduced fees and minimum investment requirements, making wealth management services accessible to a broader audience. This democratization of investing empowered individuals with the tools and knowledge to build wealth and achieve financial security. Despite initial skepticism, robo-advisors gained widespread acceptance among investors, attracting billions of dollars in assets under management. Their ability to provide personalized investment advice, rebalance portfolios, and optimize tax efficiency resonated with a generation of tech-savvy investors seeking transparent and efficient investment solutions. As fintech innovation accelerated in the 2010s, regulators faced mounting pressure to adapt outdated regulations to the rapidly evolving landscape of digital finance. Balancing the imperative to foster innovation with the need to protect consumers and maintain financial stability posed a formidable challenge for policymakers worldwide. Regulatory frameworks struggled to keep pace with the proliferation of new technologies and business models, leading to uncertainty and fragmentation in the regulatory landscape. Fintech startups navigated a complex web of regulations, often facing barriers to entry and compliance costs that hindered their growth and innovation. Despite regulatory challenges, stakeholders recognized the importance of collaboration between regulators, industry players, and other stakeholders to foster a conducive environment for fintech innovation. Initiatives such as regulatory sandboxes and industry partnerships sought to bridge the gap between innovation and regulation, facilitating responsible experimentation and fostering trust in digital financial services. The rise of the gig economy in the 2010s transformed the nature of work, empowering individuals to monetize their skills and services on flexible, on-demand platforms. However, traditional financial institutions struggled to meet the unique needs of gig workers, who often lacked stable income streams and traditional employment documentation. Fintech startups seized this opportunity to address the financial inclusion gap, offering tailored solutions for gig workers, such as digital banking accounts, instant payments, and access to credit based on alternative data sources. These innovations enabled gig workers to better manage their finances, build credit, and achieve financial stability in an increasingly digital and gig-centric economy. By leveraging technology and data analytics, fintech startups provided a lifeline to millions of gig workers who were underserved or excluded by traditional banking institutions. Their ability to adapt to the evolving needs of the gig economy underscored the transformative power of fintech in fostering financial inclusion and empowerment. As digital banking and fintech gained momentum in the 2010s, concerns about cybersecurity and data privacy emerged as paramount issues for consumers, businesses, and regulators alike. The proliferation of digital transactions and the storage of sensitive financial data in the cloud posed unprecedented risks, ranging from data breaches to identity theft. Fintech companies invested heavily in cybersecurity measures, employing advanced encryption technologies, multi-factor authentication, and continuous monitoring to safeguard customer data and prevent unauthorized access. Regulatory authorities also stepped up efforts to enforce stringent data protection regulations and hold companies accountable for breaches and non-compliance. Despite these efforts, cyber attacks continued to evolve in sophistication and scale, posing a persistent threat to the integrity of digital financial systems. The cat-and-mouse game between cybercriminals and cybersecurity professionals underscored the need for constant vigilance and collaboration to mitigate risks and ensure the security of digital banking and fintech platforms. As digital banking and fintech reshaped the financial landscape, the need for financial literacy and education became more pronounced than ever before. While technology democratized access to financial services, it also exacerbated existing disparities in financial knowledge and literacy, leaving many consumers vulnerable to exploitation and misinformation. Fintech startups recognize the importance of financial education as a cornerstone of their mission to empower individuals with the tools and knowledge to make informed financial decisions. They launched initiatives ranging from educational content and interactive tools to gamified learning platforms. Fintech startups recognize the importance of financial education as a cornerstone of their mission to empower individuals with the tools and knowledge to make informed financial decisions. They launched initiatives ranging from educational content and interactive tools to gamified learning platforms aimed at engaging users and demystifying complex financial concepts. Through partnerships with schools, community organizations, and employers, fintech companies sought to reach diverse audiences and bridge the gap in financial literacy. By empowering individuals with the knowledge and skills to navigate the increasingly complex financial landscape, these initiatives laid the foundation for a more financially resilient and empowered society. Financial education wasn't just about teaching people how to budget or save. It was about instilling a mindset of financial responsibility and empowerment. By fostering a culture of lifelong learning and curiosity, fintech companies hope to equip individuals with the resilience and adaptability to thrive in an ever-changing economic environment.